Yo, what's going on, everyone? Welcome back to another YouTube video. I hope you guys are all having an amazing day, morning, night, week, month, wherever you may be. Alhamdulillah, I know I'm having an amazing morning. I hope you guys are all having an amazing morning too. But in today's video, what we're going to talk about is a different type of structures that's not generally talked about. And I don't just mean the iconic uptrend, downtrend, and then the consolidation. We're going to go more in depth into it because I'm starting to realize that a lot of the issues we have with structure is because we have this weird fantasy that structure is going to look exactly like this, and that when it's time to sell, the market is going to provide you a beautiful, clean textbook opportunity that we see when we draw it out with a pen. Well, the reality is when we draw it out with a pen, it's just a general idea of what it looks like, and we're not really doing it justice. But with candlestick, it's much more advanced, it's much more messy because of the wicks, and overall it's not going to be as clean and crystal clear as we make it out to be. So within these uptrends, within this uptrend, downtrend, and consolidation, there's different types of styles within that trend or within that style, meaning that an uptrend can either go up like this, right, where it just simply flows, or an uptrend can go down up like this, where it's not really flowing, it's grabbing more liquidity, or an uptrend can just go up like this. So we all know that there's different kinds of uptrends, but if I simply teach one type, which is this, and you're faced with a problem like this, you're not going to know how to handle that. And of course, that's when overtrading happens and emotional decisions are made. So it's best that we understand how to trade every single one of these styles, and that's why I've mapped up these three structures right here, or rather these three styles of structure. So the first one is called the congested orders, up but sideways, question mark, meaning that, of course, I'm going to provide you an example, but as we can see over here, that overall the market is desired to go up. We are looking to move higher and appreciate the price, and the value of the currency is going to go upwards. But before that appreciation happens, before the market impulses with a bunch of orders, we can see that price actually is coming down, and then it stops for a while, it consolidates, and after the market does whatever it needs to do, as specifically pick up orders, liquidity positions, then it goes up. Now, of course, this isn't going to look exactly like this, but this is just a brief example of what we're expecting. Now, here what we're seeing is price is congested, meaning that the market is not simply just going to go up like this. Overall, the market is congested with a bunch of orders. So think of orders like this. The market needs to pick up orders. That's all it is. The market has to pick up orders. Everything is orders. If we have 1,000 sell positions, but then we have 2,000 buy positions, remember this is a bank, not retail orders, these are bank orders, then the market is overall more likely to go upwards because there's more buy orders than sell orders, and vice versa. If there were 4,000 sell orders, the market would obviously go down than up because there's more orders for sells. Now, in a position like this, or in a situation where the market is congested, that's mainly because the price action is looking to distribute, sorry, not distribute, but is looking to find the most, the word I'm looking for, it's not premium, but it's, yeah, it's the cheapest level essentially. So you have to find that distribution level point where the market makers are finding cheap price points to buy and sell at. So essentially what's happening is the market is consolidating in order to liquidate positions so that it can go downwards into a demand zone that has orders which could fulfill the orders that they need to prolong and continue the move up. Hopefully that wasn't confusing, but if it was, I'll break it down again more specifically, and I also have a couple of examples of how we can use this to our benefit. So essentially what's happening is we have sell positions, but the overall position, the overall objective is to go upwards. The problem is the banks can't just buy whenever they want, sell whenever they please. There's a whole algorithm to it. They have positions, they have points where they need to take the market. As in, if the banks were just buying and selling out of whim, right? Let's assume they start buying in the middle of a position here and selling here, and etc. They wouldn't be, or not, actually that's a bad example. They'd be buying here and selling here. They wouldn't be getting the most out of their position at the end of the day, right? Because you could buy at such a cheaper point, make more money, and sell at a higher point and make more money. So basically, it's all about making the most money. And in a situation like this, we can see that the banks are essentially looking for, or if they're looking for a demand zone to fulfill the orders that they need in order to take the price higher. And a lot of the times what we'll see happen is, for example, you'll see a market go up, and within this impulsive move right over here, actually let me highlight it in blue just because it'll look nicer. But within this impulsive move, you're gonna find that there's order blocks at the bottom, there's order blocks at the top or in the middle, and there's order blocks at the top. And you might be wondering, why is it that the market usually goes down? It invalidates the first few order blocks, finds a different order block, and then it goes up. So the logical reason is because these order blocks were just stronger. But the more in-depth explanation to this is that these order blocks over here did not fulfill the orders that they needed, that the banks needed in order to prolong the move up. Meaning that the banks need a specific amount of orders. Let's say the banks have about 20,000, or more specifically, and realistically, let's say the bank have 2 million orders. Right, they have 2 million orders that they need to fulfill, but this order block is only providing you with 1 million. So in that case, you might see a small retracement, but that's not sufficient enough to actually make the market explode. So what they do is they bring the market down until they find the order block / demand zone that has the sufficient amount of orders to continue the impulsive move, and that's when you're going to see that move. And something more, and there's a little secret I'm going to give out right now, is that when price action does reach those order blocks, usually you're only going to find confirmation on the smaller time frames. That's literally it. You might find confirmation on the 1 minute and the 2 minute, possibly the 15 if you're lucky, but beyond that, I don't think there's going to be confirmation. Only thing's going to happen is you're probably going to miss the move. So that's the congested order is up but sideways. The reason I say up but sideways is because we know that the market wants to go up, but before it goes up, we consolidate for a little bit. Now the downwards manipulation is similar but a little bit different. Once again, like I said before, within a downtrend, there's multiple styles, meaning that the market can trade like this, or it could trade like this, or it could trade like this. It could consolidate, go up and down. You see what I mean? So it could be different. In this case, I'm sure a lot of us have experienced a situation where the market goes down and it cleans structure. Let's say there's a structure point here and we cleaned it with this low. And an order block is present. So the most realistic thing to do would be take this supply zone and try to sell there, or look for confirmation. Most traders would try to sell here and not look for confirmation. What ends up happening is the market actually takes out this order block, this supply zone. They invalidate it, they liquidate it, matter of fact, and then a new order block is created, / supply zone is created over here, and that's the supply zone that the market uses to further go down. I personally call this the downwards manipulation. The reason I call this the downwards manipulation is because the overall trend is down. We're in a bearish trend, and you were right about the direction. Remember, the easiest thing is being right about the direction. The hardest part is being right about the timing. So you were right about the direction, and the banks knew that you were right about the direction, but they manipulated these sell side order blocks so that you would not catch the trade and that the market would go down. Or that could just be my opinion. But that doesn't, honestly, that's not as important as what's more important, which is to know that how to handle these situations. And then the third structure is structure by order flow. And this works for uptrends as well. Now, structure by order flow is ideal. Imagine that as being the most ideal situation ever. Essentially, what happens is after every single low that's taken out, the market just retraces back to the order block that was the cause of the move down. As in, for example, we can see that there's a break of continuation of structure rather here, and then the market breaks that low and it slowly trades within this order block right here. They fulfill the orders, and then vice versa. It happens, and sorry, not vice versa, but then it's a cycle. It continues. The next low is broken, and then price action goes back up into the last supply zone, and then from there we sell off. So as you can see, there's multiple different styles, and this is probably the best and easiest style to trade. Now we're going to apply these concepts, of course, to EURUSD and a real chart example, because we can only learn so much off of these hypotheticals. So essentially on EURUSD, what did we see happen? So throughout this week, let me actually turn on this session of the day. Matter of fact, if any of you are looking for this indicator, it's amazing. It's called Session and Days of the Week. It labels out all the days of the week. So yeah, there you go. But this weekend, we actually saw a lot of consolidation. We saw a lot of consolidation. If we just go back towards Monday, and I blank all of this out, what do we see? We see that the market is overall trending in an uptrend. It's overall looking to go higher. But how do you trade such a situation like this? And this is actually a test. What does this look like? What style of trend is this? If you said that this was the congested orders but up sideways, or matter of fact, let's just change it to congested orders. because it goes for both. This isn't just for an uptrend. So if you said that this is the congested orders, then you were correct. And I'm going to teach you how to handle this situation. So in a position or in a situation where price action is extremely congested and nothing is making sense, you don't know whether you should buy, you don't know whether you should sell, you don't know what's going to happen next, don't worry, I got you. Essentially, the secret to this is understanding supply and demand and understanding where price action is moving from. So what do I mean by that? If I open just a brand new chart, we can see that if I delete this right here, we want to ask ourselves the first question: where is the market moving from? What do you mean by where is the market moving from? It's very simple. More recently, what did we see? Well, we saw that price action has gone up. Where did the move start? That's the first thing we want to ask, is where did the move start? The move started over here. And if I look past that or before that, we can see that from this point to this point, it was all bearishness. But at this area, just over here at 1.05734, the market reversed. So that means there must have been something significant there in order for the market to reverse from bearish to bullish. Although the overall trend was bullish from the beginning, it was just a small period of time, a brief period of time where the momentum was bearish in order to do what? In order to manipulate, congest, and then find the place where price action was going to accumulate the orders and then reverse. So right over here, there's something interesting. And if I look towards my left and I use the 8-hour time frame, we can see that there is an 8-hour order block, an 8-hour area of demand. Let's use this right here. Yes, we have an 8-hour area of demand that the market had used. So some of you might be wondering, why did I use the 8-hour? It's because a lot of you must have just probably, or a lot of you would have just probably used the 4-hour order block founded right here. So it's extremely important that you use your time frames. You don't have to stick to one. It's actually important to use a lot of time frames. That way you get an overall idea of where the order block is. Because if you just take a look at the 8-hour and then you make your way to the 4-hour, you'll notice that the 4-hour is just a mitigated, or sorry, not a mitigated, but a refined version of the 8-hour time frame OB. But we can see that after the market had entered this point of interest, there was one mitigation, a second mitigation, and then we ended up liquidating both of those orders, both of those lows with this final low, and then the market had reversed. So what was happening within this area of congestion? What was happening is the market was looking to find the best point, the best area, the cheapest point where they could buy back up. Because they started to sell over here. And in order for someone to sell, there must be a buyer on the opposite end. So when the market started to sell off, they also need to buy back up because the overall objective is to take the market higher. So why did they sell from the beginning? In my opinion, the reason price action sells from the beginning, you might say it's the market maker, the banks, whatever. But the reason the market does sell off for the beginning could be two reasons. One, retail orders are in control from this point to this point. Remember, this is my opinion. Retail orders could be in control. And then after the banks find the point where they want to buy, they start buying, and all those retail orders are liquidated. So anyone who was selling from this point, this point, this point, this point, they got mitigated. And more specifically, if we zoom into the smaller time frames, what can we see? We can see that there's even smart money traders looking to hedge. Sorry, not hedge, they're looking to sell. We have smart money orders from this point that are selling. Because what happens? You see that they say there's a breaker structure, price action goes back up, and you continue to follow that order flow. You continue to follow that order flow up until it doesn't work anymore. Why doesn't it work? Well, it's because we were ignorant about the higher time frame demand. We were ignorant about the fact that the reason we were going down from the beginning is so that the banks could find a cheaper price point, a more better price point to buy at, so that it's at their benefit and they make the most money. And that's exactly what happened. So we could see that price action enters this 8-hour point of interest, and as soon as that 8-hour point of interest was mitigated, we saw the reversal took place ASAP. And then from there, the market started to go up. And now, most probably, as long as the momentum is still there and the orders and there's sufficient orders, the market should continue to go up and surpass this high right over here. And the first mistake a lot of traders will make at this point is they're not thinking about what's going to happen with this move. What is this move going to do? Well, overall, I know because from experience, the market is going to probably go up and take out that low. So what I should be doing at this point is looking at the smaller time frame to catch the retracement to buy back up. But what a lot of traders will do instead is they're going to start to sell this point. They'll see on the 30-minute time frame a strong move down, and they'll start trying to sell this point, not realizing that price action has already moved off of a higher time frame demand. So that's the congested orders. Essentially, the way you trade this is you go back to the higher time frames or the desired time frame of whatever time frame you're on, because structure could be different, right? As in, if I go to the 15-minute and I see the same thing happen. By the way, the smaller the time frame you go on, the more confusing it's gonna the more confusing it's gonna get. So I try to stick to the higher time frames, such as the 4 hour, the 1 hour, and essentially that's all it is. As soon as you find the 8 hour demand zone or the 4 hour demand zone, wherever the demand zone is, that's when you want to change your mindset from things are going down to when is price actually going to reverse? Because as soon as we saw this reversal, because where was the reversal? The reversal was seen and identified as soon as we saw this break of structure. As soon as that break happened, we noticed the reversal. And from that point on and forward, all you had to do was find your demand zone, your refined demand zone. And of course, we would look for smaller time frame confirmation because it's a pretty big zone. It's about 17, 18 pips. So you look for confirmation on the smaller time frame and you take your trade. But that's videos for a different topic because we're not here to talk about confirmation. So this was the congested orders, and I'll provide a couple more examples if I could find any. Here we are. I found one just here. I found a perfect. Oh, actually, no. This one is going to be for a different example. We'll use this one right here. So we can see once again that overall we are consolidating. The market is trending up at the moment. From momentum, we can see that we're trending up from a micro perspective, but we're overall consolidating in a consolidative trend. So what do? The first thing is look for your demand zone. Where is the market heading from? Or where's the market going from? And in that case, if we go to the 4 hour time frame, we have a couple of options. We have one option over here, and then you could have another option somewhere over here, right? Depending on how the smaller time frame would provide that opportunity. And then you could see that this price action provided. Yes, it does. So in this area of consolidation, all the market did is it went all the way back down. It found the order block in which price action was moving away from, and it used that to fulfill the orders that price needed to go up. And then from there, the market rallied to wherever it needed to rally. And then the banks obviously reversed the price, and the downwards direction was continued. Now we're going to move on to the second one. The second, my apologies. The second one was the downwards manipulation, and I found a couple of examples just over here, I believe. Yep, it was right over here. So this is called the downwards manipulation. If we go to the 8 hour time frame, what do we see? Just here. Okay, cool. We can see that the market has made a huge impulsive move downwards. There's a huge impulsive move downwards. Not only that, but there's also order blocks. There's one over here. There's one over here. And you could debate that there's one over here. Yeah, there is. So most of the times, I don't believe traders are taking a look at the higher order blocks, which are more premium, right? Premium, not discounted, but premium. More specifically, we're actually focusing on what's recent, on what recently happened. And what's the best? So how would you avoid this? We'll take a look. We can see that the market mitigates this for a bit, and then eventually we end up invalidating it. So how could you have avoided this? The best way to know of how you could have avoided this is by looking at the previous patterns before this happened. What do I mean by that? We'll take a look at the structural pattern. Has the market been making deep retracements, or has it been making small retracements and then continuations? Meaning, like, if price action has been doing something like this, then we can assume, because the pattern has been happening, that there's a high probability that the market is going to reach this point, this area of supply, and then go down. But in this case, we can see that the market had not been making any big retracements, right? There hasn't been any deep retracements. Rather, it's a small retracement and then a continuation. Small retracement and then continuation. So when you have that in your head, once you know that there's no probability, meaning that it's not even unlikely, but it's also probable, meaning that it's 50-50, that's when you have to keep an open mind available. You have to keep your mind open for all possibilities. Because if I have one specific pattern that's continuously being followed, at that point, then I have an idea, okay, the market is going to make a 90% retracement. Or in this case, the market is going to make a 60% retracement. Or in this case, the market is going to make a 10% retracement. But in the situation where there's like literally no retracement, the market isn't following a specific pattern. Oh, oops, my apologies. Just leaked the free signal. Yeah, where the market isn't following a specific pattern, then at that point you know that you have to keep your mind open for literally every single possibility. So once we saw that this big move up happened, what do we do? The first thing is you also have to take it for face value, meaning that you want to monitor this zone for confirmation, and if confirmation isn't present, you would dump that zone and you move on to the next point. And then we also want to keep this zone for confirmation and then this zone for confirmation. And what ended up happening is the market actually invalidated this point of interest. Possibly there may have been an entry on the smaller time frame, but I don't think so. And then what ended up happening is, once again, price action moved away. And what did I say? What did I say before? I said that usually for these points of interest where the market finds the exact point where they want to sell off and they invalidate it, a new order block is created. So this new order block is created and the market will not stay there for a long time, meaning that you might find confirmation on the 1 minute, the 2 minute, the 5 minute, possibly the 15 minute, but after that, anything beyond that, you will probably miss out, or you're gonna have to wait another day or two depending on what the structure is looking like for an entry. And that's exactly what happened. We can see that the price action entered this point. There wasn't much consolidation going on. Really, price action went in. 1 minute, probably 5 minute time frame was confirmation was provided on those time frames, and then the market sold off. So that is the second one, called downwards manipulation. This order block, this supply zone, was manipulated for another supply zone to be used, and at that point those supply zones were used, the orders were fulfilled because they had sufficient orders, and then the market sold off. So once again, the best way you could avoid this type of structure is to have all the order blocks / supply zones on the higher time frames marked up. Make sure you observe confirmation for all three of those OBs, or else essentially you're doing guesswork. You're guessing that this OB is going to hold because there's a higher probability, because you think, but there's no actual proof to back that thought process up. So what I usually do is I mark up all these points of interest, 1, 2, 3, and more specifically, I'll give you another hint, is you want to take a look at how structure actually reacts off of these points of interest. Meaning that if momentum and volume aren't there, then you can have a sign. That's going to be a sign that the market is probably going to continue up. But if momentum, volume, structure, order block, and all of those confirmations are present, then at that point, it would be sufficient for you to take a trade. But and then the third and final one, which is structure by order flow, and I'm going to provide an example from GBP USD for that one. So structure by order flow, before we actually even go, let me provide the theoretical example again. So structure by order flow is really simple. It's essentially when the market is moving from supply to supply or demand to demand. As in, after every single low that's taken out, the market goes back up to the supply zone and then it goes down. And then it makes back up to the supply zone and then it goes down. Retracement to supply, go down. And as I said before, this is a pattern. And if this pattern has been being followed consecutively throughout the entire week, throughout months, because it happens for months sometimes, then at that point, you know how big of a retracement you're expecting. You know what you're not, you also know what you're not expecting, meaning that I'm not expecting the market to make a small retracement and go down, or a big random reversal and go up. So for example, as in, let's say on the monthly time frame, price action has been doing this, right? Now, of course, on the monthly time frame, there's not going to look like there's any breaks of structure. But on the weekly or daily time frame, you might see something like this, where there's a break of structure. But because we know that overall on the monthly time frame, the market makes big retracements towards areas of supply that are premium or discounted, if of course we're using a sell example, we're just going to say premium, then you know that those breaks of structures are nothing except a break of demand or a break of supply to rally to a better area of supply, a stronger area of supply. So that's the power of understanding patterns. And moving towards GBP USD, we can see that throughout the month, we'll use the daily example instead. I'll use the monthly example. So throughout the month, this moved down. On the monthly time frame, there's nothing there. We can't see anything. But on the weekly time frame, can we see anything? Yes, we can. Matter of fact, I'll scale down to the daily just so it's even cleaner. So after the first low was broken, this low, because as you can see, we were rallying up until we broke past this low. So now we know that the overall trend is looking to go down. But what happened after that low was taken out? The order flow started, and this order flow is beautiful. Price action rallies all the way back up to the original area where the market had sold off, to mitigate the supply zone at the top. From there, what happens next? The same thing happens. The market breaks some demand in this area right here, and then price action rallies back up towards this area of supply to mitigate it. And then this low is taken out, right? This very low right here is taken out. And then the market rallies all the way back up to the top. And as you can see, it's an entire pattern. It's a full pattern that consecutively happens over and over and over again. So the question comes, how can we take advantage of this? Once again, it's here too. After the market enters the supply zone, you look for this break of demand. And then what does the market do? It rallies up towards this area of supply and it goes down. And it happens over and over and over again. Once again here, you can see that there's this area of supply, or this area, this low is taken out, and then a new area of supply is created. The market rallies into it, and then boom, it sells off. So we have a total of 1, 2, 3, 4, 5, 6 opportunities from the time span of last July to this year. So those were 6 opportunities, and if you're a swing trader, that would have been big money right there. That's a bag and a half. So so then the question comes, okay, we see this, like you see this now, but how could I have trained my eyes to see this beforehand? And I'm going to make it very, very simple. Take a look at this. So if I was a participant around this point and I saw that because remember, the first thing you want to ask yourself is, number one, what is the trend? Once you understand the trend, ask yourself, what is the style? That's what we do not ask each other. What's the style of the trend? Once you understand the style of the trend, you crack that down and you realize that the market is reacting off of order flow and price is over here at this point. All you have to do is wait for price action to come back up to this area of supply. That's it. So that means you don't have to check the lower time frames anymore. You don't have to scalp. All you have to do is remain patient, because if you remain patient, you could set a limit, because confirmation is technically provided. Put your stop loss at the high and your take profit wherever you're targeting. So let's assume you're targeting this higher low right over here, and that's it. But where does the mistake happen? Where does the mistake occur? The mistake that a lot of us make is that we scale down to the 4 hour and we get lost in the sauce. You get lost in this supply zone. Essentially, you get lost in the smaller time frames. You got lost in this supply zone, and that's all because impatience. You want trades quickly. You want them fast, but that's not going to happen. Remember, if I know that the pattern is the market is making large 90% retracements of the impulsive move, then I know for a fact that these supply zones will most probably not hold. And if I know that these supply zones will most probably not hold, I don't have to sell them anymore, and they're no longer up to my they're no longer key points for me to focus on, and that makes my job a million times easier. So what would I have done? I simply would have just waited for price action to reach that area of supply. Once that area of supply is there, you are activated, you could wait for confirmation, you could wait for a break of structure, you could set a limit. It all really just depends on your style of trading. And once again, we have another break. Basically, after every single low is taken out, there's a retracement. And after that retracement happens, what do you do next? You wait for that low where the retracement started to be taken out. So everything's up for grab. Meaning first, this was up for grab, but the market needed to mitigate supply in order to take this out. So boom. Right now, this is not up for grabs because we need to go up first. So what are we going to do? We wait. As you can see, the market didn't go up. So you wait, and boom. Price action is starting to go up. What do you have? We have our more recent supply zone right over here. That was the cause of this move down. And now this low right over here is up for grabs, meaning that this is our next target. And that's the beauty of order flow, is the market just moves from low to low, supply from low to low. And the beauty about all of this is it's so easy to spot on the market. You just have to be more patient. Oops, I made a mistake. Sorry. It was this one. Yeah. But honestly, this would have been valid too. So in a situation where there's two supply zones valid, right? What you could do is you could wait for confirmation on the one below and set limits at the top, because technically the one at the top is much more premium, meaning that it's just stronger. It's better for them to sell over there, and the one below is less premium. So that means wait for confirmation on this one and set limits here, or set limits 50%, meaning split 1% into half. So you put 0.50 at this point, and then you put 0.50 at this point, and that's something a lot of us would do, which makes sense. And then what's next? this is the next low that's up for grabs. So that's the beauty behind structure, and that's the beauty behind understanding the styles of structure. Now, before I end this video, I just want to provide an example of a trade I took this week on EURUSD. It was took during London session, and it was during this the second style of, or the first style of trading, which is the first style of structure, which was the congested orders. So what happened? Essentially, price action was over here, if I remember properly. Yes, the market was over here, and once I saw that the market had taken out this high, I knew that now the market is ready to take off, because we've already executed all the orders that the market needs to further go up. So what happens next? So what happens next is I'm taking a look at my lower time frames to see where my demand is, So even within the congested orders, the congested order style of structure, after you see the break of structure, the most important move is going to be the impulsive move that caused the break of structure. So in this case, it's right over here. This is the most important move right here. Now what you want to do is you want to find the order block. You want to find the level that caused the market to go up. And in that case, I believe it was something like over here. Let me just take a look, because I can't remember too well. Yes, I think it was here actually. Go to the 5-minute time frame. Hurry this up. Oh, here we are. It was just over here. I found it. Perfect. So price action stops at this point. If I look towards my left and I go to the 4-hour, we can see that there's a level of demand here. Now it's very ugly. I have to admit, when price action is like does stuff like this, where there's a lot of wick action, basically you can assume that there's a lot of manipulation going on. But the best thing you can do is, instead of trying to pinpoint the order block, wait for the market to fall and let it tell you where price action finds demand. Because if, let's say I don't do anything, right? And then automatically I see a wick like this, where there's and this wick signifies that there's weakness, that sellers brought the market all the way back down, but something happened over here. Some type of orders were executed that caused the market to do what? That caused the market to reverse. So at that point, I'm already thinking that there's something important here, although I can't see it because of how ugly it is. So I'm just going to trade off of the demand that I'm seeing. So what happened next is I saw that the market created this move up. Once we saw that move up, I saw that there was a break of structure on the smaller time frame, which once again is the first confirmation that price action is reversing. Once we saw that break of structure, there was another point of interest right over here, and boom. Another small point of interest right over here. Why did I use this point of interest? It's very simple. Number one, break of structure. So we have, this is my higher time frame point of interest, higher time frame POI. The next point, the market reaches this area of supply, it goes up, and what does it do? It breaks more structure. So this is the cause, this is the beginning of the move up, meaning that all the orders that were over here were sufficient, and that caused the market to go up. Not only that, but we also have imbalance. So at this point, limits could have been set, and boom, the market from there just takes off, and it goes all the way to where targets were, which were around here, and the market hits targets. I don't think I actually targeted there. I think I was actually looking to sell at this point because there was a high probability there, but because no confirmation was provided, we did not take that sell. But yeah, and that's what I have for you guys today. So I hope this video was helpful. I hope it was fruitful, informational, and you all learned something new today. Basically, to summarize what we went over before I call this a day, is that within structures there's styles of trading. Matter of fact, I just seen one right now, or there's different styles of structure. So we can see that price action goes up and it goes all the way back down to mitigate this daily area of supply. Price action goes up, go to the 12-hour this time. We'd literally just be expecting the market to come back down to this point, but sadly that's not what happened. But that could happen in the future, because technically we were following the order flow style of structure. So basically, this was the styles of structure video. To summarize what we went over the 3 styles of structure. Structures are not just up, down, consolidative. Rather, there's styles within these concepts, and if we understand what style is present in the market at the moment, then we'll know how to react, how to predict, and what to anticipate, and what's going to happen next. So I hope this video was helpful. If you found this video helpful, please leave a like, comment, and subscribe. And until then, I'll see you all in the next video. Peace out.